A hedge fund manager in Connecticut wrote the IRS a check for $400,000 in January. On purpose. Knowing full well he overpaid by roughly $90,000. He did not make a mistake. He planned it months in advance. That is not generosity. That is a strategy. And the wild part? He is not alone. This is a documented pattern among high net worth earners, and nobody in mainstream personal finance talks about it. Because if they did, the entire narrative of just pay your taxes and move on starts to crack. Here is why this matters to you directly. The difference between people who build wealth and people who just earn money is not income. It is how they interact with systems. Tax systems, cash flow systems, timing systems. The wealthy do not just pay taxes. They choreograph them. So let us talk about what is actually happening here. In January, a self-made millionaire often faces a decision about estimated taxes. These are quarterly payments you make when you earn income outside of a traditional paycheck. Freelancers know this. Business owners know this. And high earners with investment income absolutely know this. The IRS has a rule called the Safe Harbor Rule. It says if you pay at least 100% of last year's tax liability through withholding or estimated payments, you avoid underpayment penalties. If your adjusted gross income was over $150,000 last year, that threshold bumps to 110% of last year's liability. Most people hear safe harbor and stop there. They pay exactly what they owe. They call it responsible. Millionaires hear safe harbor and ask a different question. They ask, what happens if I overpay beyond that threshold on purpose? Here's what happens. The IRS holds your money. You get zero interest on it. You file in March or April. You get a refund. Sounds useless, right? Wrong. And this is the part that nobody explains properly. The overpayment is not about the refund itself. It is about what the overpayment signals to lenders, accountants, and business partners in the first quarter of the year. January and February are when deals get structured. Lines of credit get reviewed. Partnership agreements get drafted. And in those conversations, showing that you have already satisfied your annual tax obligation in full, in January, changes how people talk to you. It is a liquidity signal. It says your cash flow is so strong that you can park six figures with the federal government and still operate comfortably. Banks respond to that. Investors respond to that. It is a form of credibility that no certificate or LinkedIn badge can replicate. There is a real example worth knowing. A woman named Patricia ran a consulting firm in Atlanta. Her business had a strong fourth quarter every year, which meant her tax liability spiked unpredictably. In her early years, she scrambled to pay quarterly estimates and always felt behind. Then her accountant introduced her to strategic overpayment. She started writing a large estimated payment in early January, intentionally above her projected liability. Her refund in March became a predictable cash infusion she could plan around. She used it to fund a marketing push every spring, right when competitors were still figuring out their tax bills. 3 years in a row, she grew revenue by over 30% in the second quarter. The refund was not savings. It was a deployment weapon. If this surprised you, subscribe right now. This channel covers the mechanics of wealth that financial media ignores because it makes the system look too navigable. Now here is the deeper layer that reframes everything you just heard. The strategy only works if your business generates variable income. And here is the uncomfortable truth. Most salaried employees cannot do this easily because their taxes are withheld automatically. Their employer owns the timing. The wealthy, almost universally, have found ways to convert their income from W-2 income to business income, not to cheat the system, but to get control of the timing. That shift, from employee to owner in any form, is what unlocks tax choreography. A freelancer earning $80,000 a year has more tax flexibility than a salaried employee earning $150,000. Not because of loopholes, because of timing control. This is why the wealthy obsess over entity structure. An LLC, an S corporation, even a simple sole proprietorship changes when and how you recognize income. And that timing gap between when you earn money and when the IRS sees it is where strategy lives. The January overpayment trick is not available to someone whose taxes are auto-deducted from a paycheck every 2 weeks. It is available to someone who controls when their income is declared and when their payments are made. That is the real secret layered inside the surface behavior. So what can you actually do with this information? First, if you have any self-employment income at all, even a side project, you are already eligible to make estimated tax payments. That means you already have some timing control. Start paying attention to your projected liability each quarter instead of just reacting at tax time. Second, look up the safe harbor rule for your income level. Know your number. 100% of last year's liability if you earned under $150,000. 110% if you earned over. Knowing that number means you can make deliberate decisions instead of guessing. Third, talk to a CPA who works with business owners, not just a tax preparer who fills out forms. The difference is enormous. A preparer reports the past. A strategist shapes the future. The wealthy do not have a different tax code. They have a different relationship with time. They plan in October for what happens in January. They use March refunds to fund April opportunities. Every move is sequenced. You have been told that taxes are something that happens to you. For the people building serious wealth, taxes are something they conduct. Like an orchestra, every instrument on time, every payment deliberate, every refund already allocated before it arrives. The next video we are releasing breaks down exactly how S-corporation salary splitting legally cuts your self-employment tax bill in half. That is not a teaser. That is a mechanism, and it is hiding in plain sight. Do not close this tab yet.